taxpayers all the way to the U.S. tax court. Also, what's not on here is that Kim is a board director for the Fountains Chamber of Commerce and our treasurer. And put your hands together for Kim Widner. Do I do it? Okay. Kim, do you want to pick it? Sure.
Me, Kim.
003.
And the number is 3987. 3987. 3987. Ooh, maybe someone
Maybe
else.
both.
Is that
I think it
both?
was the ticket that I lost. I think it's my lost ticket.
3985. Suzanne, another board director of the Chamber of Commerce. We have a calendar, the Yeti Orchard.
I will take the Yeti.
Okay, good choice.
I will
Come in, exchange it.
I
You
will-
bet. Everyone likes the other ones better. Yeah.
I'm going to do one more. 4,000. Jeannie. The calendar and the shirt I'll bring it to you.
So come on by.
Okay, all right, put your hands together for Kim. Thank you, Kim. Health insurance, awesome.
Good morning. Some great information. I am married with 3 now adult children. And I thought we were in really good shape and had things well arranged and planned. And today I feel I was more of a student than a teacher for sure. I wrote down so many things. There's a lot to get ready for. And all of our presenters have laid out some really good ideas to get things ready before that awful event. And my main focus, what happens afterwards? What happens when a loved one dies? What is your responsibility then? So if you are named as a trustee, also called an executor or administrator of someone's, we're going to call it estate. Just say you are the one that has to take care of the decedent's business. The first thing that you want to do is get a tax ID number for their estate. And you do that online and it's instantaneous. You go on to irs.gov, there will be a link that to obtain a tax ID number. You just answer the questions. What you will be, the main thing you're wanting to get is the tax ID for an estate. And by the time you're done, 5 minutes later, you'll be able to print out the tax ID. And that's going to be very, very crucial. You're going to need that to take it to banks, take it to investment advisors, anywhere that person has assets, you're going to need that tax ID. So make sure that's the first thing that you do. As the trustee, you may not only be responsible for that current tax return, but if the decedent is delinquent in past tax returns, you may have to get caught up on those as well. And I'm just going to breeze through some really critical points. There's more information here, and I just want to be available for questions afterwards. If you are married and you file a joint return and one of the spouse passes, there's really no change in what you need to file. You will continue that year filing a joint return as you always have. Even if your spouse died, let's say January, as long as they died sometime during that year, no change. You file a joint return just like you always have. Key point though, if you get a refund on your joint tax return, I highly recommend that you get a direct deposit of that refund into a bank account rather than waiting for a check from the IRS. Because a lot of times that check, because you filed a joint tax return, will be written out to both spouses. And you cannot cash that. You'll have to send it back to the IRS, and good luck getting a replacement. So really, get a direct deposit of your refunds when you're filing a joint tax return with a deceased spouse. Outside of a spouse dying, if the decedent is single, or if it's someone that has filed separately, be aware that there's actually going to be 2 tax returns you need to file. The first one is the period when that person was still alive. From January 1st of the calendar year until their date of death, you're going to file a normal personal tax return at 1040. And then the second tax return that has to be filed for that same year would start on the date of death and go till year end, and that is the return of the estate or the trust. So there's 2 separate tax returns that have to be filed in the year for the year of death, unless you're a joint spouse. So Bob mentioned, of course, that estate taxes only kick into place when you have assets greater than $12 million. And in that case, there is another form that you would need to file, and I'm not going to get into that today, but it's the 706, that's the estate tax return. But I'm just gonna say, probably for most of us here, that doesn't come into play, and I'm not even gonna go there today. So the general rule is, when you're preparing those 2 tax returns, look at the tax ID of what that form. So for example, if you get a 1099 from an investment account for that decedent, if the number is their social security number, you're going to file that activity under their personal tax return. If that form comes with the estate tax ID number on it, that information goes on the estate tax. That's how the IRS matches up forms to reporting. So just do it that way. Even if it was incorrect, it's kind of irrelevant. Just take whatever tax ID number is on the form you're getting and put that on the respective tax return. So sort it by how those forms were issued, what tax ID number was used. Generally, the deductions that are allowed on the individual tax return are the same deductions that are allowed on the trust tax return. There is one little special rule regarding medical. For us that file an individual tax return, you get to claim medical expenses that are over 7.5% of your gross income. So not a lot of people can even take the medical deduction, plus you have to itemize. So typically, medical expenses that are paid before the date of death are reported on the individual's tax return, and those that are paid after the date of death are reported on the trust tax return. There is a law that allows you to take all of the medical expenses of that decedent, if they're paid within the year after death, all of those medical expenses can be included on the trust return. And the reason that could be beneficial is if you're splitting those medical costs into 2 different returns, you may not get to claim anything because you're not reaching that 7.5% limit. But if you push all the medical expenses into the trust return, you may reach that limit and you may get some kind of deduction. Funeral expenses. People often will give me funeral expenses in preparing a tax return. Those are not deductible. They are only deductible on the estate, the 706, which we're not talking about today. So funeral expenses are not deductible whatsoever on a personal tax return or on a trust tax return. Then I just want to go over some other things which you may not be aware of. You don't need to attach a death certificate to the tax return. Just keep that in the file for yourself in case the IRS requests it. You don't need to attach it to the tax return. If someone passes and their spouse, that they had a dependent child that they were claiming on their tax return, that surviving spouse gets the benefit of what's called a qualifying widow deduction. For that current year and the next 2 years after death, they get the higher standard deduction, as if they were filing a joint return, rather than just the single deduction. So again, that's if you have a qualifying dependent child and one spouse passes, the surviving spouse gets to take advantage of that extra deduction for the next 2 years. If the person that passes was your qualifying child and you had claimed them as a dependent on your tax return, you get to still claim them on your tax return that year of death. So let's say a child passed in January, February, you still get to claim them as a dependent for the entire year, no matter when they passed during that year. And then as Bob and several other people pointed out, this is very important to know. When a person dies, the basis of their assets increases to the fair market value at the date of death. And the reason that's very important is for the beneficiaries of that property, there's likely less of a gain. Let's say I bought a home at $250,000 and I bequeath it to a grandchild. And they immediately sell it for $800,000. They don't have to recognize that gain from $250,000 to $800,000 and pay tax on it. Let's say on my date of death, that home is now worth $600,000 and the grandchild tries to sell it. They only have to pay the gain on that increased value at my date of death until the time they sold it. Now, if they get it right away on my date of death and they sell it within a week, there's likely no gain. So they don't pay anything on the sale of that house. If they keep it for a year and they get $200,000 on it, so just be aware that everything gets up, even investments, not in a retirement account, but in a, say you have a brokerage account. All of those assets get revalued to the market value of that stock on that date of death. It's like your portfolio starts over at a brand new value as of your date of death.
Kim, how are homes stepped up in a logistical way? How is it valued? Is it appraised by?
You can get an appraisal, but you don't have to. You can simply go onto Zillow or anything and take a picture of an estimate.
Okay.
You don't have to pay for an appraisal. You can get a mark. You can, if you have a realtor friend, they can, write something up. It doesn't have to be anything real complicated.
You're talking about this with regard to people who have a trust, where you have to develop an A and a B trust.
No, this is for anybody. Anybody.
But a trust would not necessarily be handled that way. My understanding is that you immediately have to divide your assets, A and B. The A person's still living, the B is gone. And while the A is living, they can use up the B's assets.
If they're a spouse,
Yes.
yes,
That's what I'm talking
that
about.
is correct.
Well, yeah, I don't think you would make a trust with anyone else, right?
Sure. If you have children or, absolutely.
Your children.
You make a trust with your children.
Well, pass it to them in a trust until they
Yeah.
are more mature age, like 80. And the AV trust with the exemptions of the 12 million are now increasingly rare. And most of my clients that have AV trusts are simplifying it, revising their trust down to a single trust, assuming the kids are common to the marriage. You don't need the AV if you've got an exemption, and there's something I
Is
didn't
that
mention also.
something new?
Do you have
You don't
an
need
AV trust?
an AV?
Well, not if you're under the exemption amount, $12 million or $6 million. And then there's another concept that's maintenance portability.
One thing that was pointed out is trying to manage the tax rates of the beneficiaries that are receiving your assets. So when I do a trust tax return for a client, I do a what-if scenario. I say, okay, if the trust pays the taxes on all of this income, here is what rate it's at. Or if you pass the income on to the beneficiaries and they pay the taxes, here's what that's going to be. So have your tax preparer do that. Look at it both ways, because the trust can pay the taxes and therefore the beneficiaries don't have to. And trust rates keep changing. Sometimes they're at individual rates, sometimes they're different. So, or if, and by all means, the trust will pay a certain rate. If the earnings are passed on to beneficiaries and they have to pay taxes on it, it's very different. Someone could be individually in a 36% bracket, some could be in a 12. So you gotta kind of manage that a little bit. In a lot of cases, what I have found is that it makes more sense and it's just easier on the beneficiaries if the trust just pays all of the taxes rather than passing it on and have the beneficiaries do so.
Can that be a directive that's part of your trust, that that's how you want it done?
It can be, but I think it's better off to see what
Most
results in the most tax savings. Sure. Yep.
right at the moment that you need to know.
Yes.
Yeah, so you could put down, you could put, say, you know, I would prefer that taxes got paid from the trust, but obviously they'll make that decision at their time.
Yeah, and usually the beneficiaries will want to make that.
That's not required.
So there's more stuff in here, but I want to just leave a little room for questions if you guys have any.
I have one. You mentioned at the beginning that if you're married and your spouse dies, you do need to get a tax ID number?
No,
Only
you just keep going.
when you're both gone.
Yes, that's correct.
Could you explain the purpose one more time of this tax ID for an estate?
Yes. So, when someone dies and someone steps in as the trustee to manage the assets of that deceased person, if they have no surviving spouse, their stuff goes into an estate. Whether they have a trust written or not, it becomes an estate. And so you, as the person responsible for that estate, in other words, paying all debts of the estate and distributing the assets, and that's your responsibility until every single asset is disposed of. You have to get a tax ID for that estate.
So I would have to get the tax ID of my own estate.
Of someone's estate that you're handling.
Oh, if somebody's
You don't,
estate.
not your own.
Oh,
Because-
okay.
Because after you pass, whoever you have in charge of your estate,
They
will,
need to get-
you don't get the tax ID until the estate begins, which is the date of death. You don't get one before.
Okay.
Yep.
I have one quick question. We're all alive today, and we all have a tax ID when we file our
Your
taxes.
social security number.
Okay, no, what I'm gonna say is, the tax ID is that what you're saying, or so it is? Okay, because what I'm saying is, if you're a person, then why can't you use the same tax ID you have when you're alive?
Nope.
And I'm just asking why.
Because it's a whole different entity. You
Oh,
are
okay.
no longer you yourself alive
Okay.
having this income.
Okay,
Now it's a brand new entity. You have passed.
I see.
And so a brand new entity, the estate, is now owner of all of those assets,
I see.
including brokerage accounts, whatever. It's still making income, right? I died. Before I died, I was making the interest and dividends and stock sales. After I died, it's a whole different entity, which requires a different tax ID number.
There's a lot of fraud that goes in. Think about a social security number. There's a lot of fraud that can go into that. So when you die,
Yeah.
the IRS wants to lock that down and say, look, this is done. This social security. But the problem is a lot of trusts, and it's not a problem, it's how it should be, okay? But a lot of trusts, when they're set up using one of the spouse's social security numbers. But when that person dies, when the second person in that trust dies, that social security number needs to die with that person. The IRS is going to lock it down, so you need to replace it with a TIN, a tax ID number, so that you can continue to operate within that estate. And then you're going to file that estate's taxes. So you're even going to want to hold some cash back as you're dividing assets. Kim would advise this, but you're going to hold some cash back as you're dividing those assets, so that when you do that file, that tax return file, if there's any taxes owed,
Yeah.
there's still some cash in that account
Exactly.
to pay it, and then you'll do the little final residual distribution to everybody.
So if you are the trustee, don't give everything away. I mean, you can, but hold some back until the tax return is done, especially if the trust is going to pay those taxes. You know, a revocable trust, like Bob talked about, that really is not reportable as separate income. We have a revocable trust, and if, you know, things that are earning income, it's still reported on our personal tax return, because it's the social security number is the identifying tax ID number.
Thank you.
I have clients all the time that ask me if I know the name of an accountant that I can refer them to. Are you still taking new clients?
I just retired from tax practice at the end of 2021. I'm still doing consulting, so I still do accounting and business consulting, and happy to talk with someone. I offer, you know, a 1-hour free consultation. But as far as tax returns, I got out of that business joyfully, but I still love to talk about how to do them and give knowledge, but I don't physically do them anymore. But I have some referrals if you.
Okay, good.
Thank you.
Kim,